Own a business? There are 6 advanced planning moves you can't afford to ignore. Business buyout arrangements. If you have business partners, you should consider a buy-sell agreement. Buy-sell agreement determines who can buy an exiting owner's shares, at what price, and under what funding mechanism. The common mistake? Having the agreement, but no funding. Using life insurance to fund buy-sell agreements. Life insurance can create the funding when it's needed. There are 2 primary structures. Cross-purchase agreement. Each owner owns a policy on the other owners. When one passes away, the surviving owners receive the death benefit. They can use the death benefit proceeds to buy the deceased owner's shares. Entity purchase. The business owns the policy on each owner. If an owner dies, the company receives the death benefit proceeds. The business can use the death benefits to buy the deceased owner's shares. The benefit can include tax-free death benefit that can be used to avoid a forced sale, outside investors, financial strain on the business. Without funding, buy-sell agreements might fail. Life insurance can be a financial strategy to help with funding. Key person insurance. Now let's talk about key person risk. Every business has someone critical: a top producer, a rainmaker, a founder, a technical expert, a CEO. If that person dies unexpectedly, the business can suffer. Revenues drop, credit relationships weaken, morale declines, clients may leave. Key person insurance is simple. The business owns the policy, the business pays the premium, the business receives the death benefit. The death benefit proceeds can be used to help offset lost revenue, hire and train a replacement, cover debt obligations, stabilize cash flow. This isn't about replacing a person. It's about protecting enterprise value. Executive bonus plans. Now let's move into executive retention strategies. An executive bonus plan, sometimes called a Section 162 plan, is a benefit arrangement to reward key employees. Here's how it works. The company pays a bonus to the executive. The executive uses the bonus to purchase a personally owned life insurance policy. The bonus is tax deductible to the business. The executive pays income tax on the bonus. Why do this? Because the life insurance policy is eligible to accumulate cash value. That cash value is tax deferred and can later be accessed tax-free through policy loans and withdrawals. Keep in mind that accessing cash value will reduce the available cash surrender value and death benefit. Benefits for the executive bonus plan can include help drive retention, financial protection benefit owned by the executive, no ERISA complexity, flexible bonus allocation. It can be simple and effective, and it aligns incentives. Non-qualified deferred compensation. For higher level executives, businesses often use non-qualified deferred compensation plans. Unlike 401ks, these plans are not subject to contribution limits, are selective, you can choose who participates, are contractual promises to pay future benefits. The company agrees to pay the executive income at retirement or another trigger event. How does life insurance fit in? Often, the company purchases life insurance on the executive. The policy's cash value accumulates tax deferred. It can be used informally to offset future benefit obligations. At death, the company receives the death benefit. This creates informal funding. It's not required, but it's commonly used because it can be efficient and flexible. Employer-sponsored split dollar arrangements. Now we get more advanced. Split dollar arrangements are a way for an employer and employee to share the cost and benefits of a life insurance policy. 2 common types. Number 1, economic benefit regime. Employer owns the policy. Employee receives the death benefit protection. Employee is taxed on the economic value of the benefit. Number 2, loan regime. Employee owns the policy. Employer loans premium payments. Loan accrues interest. Policy cash value may help repay the loan later. Split dollar can help enhance executive retention, create long-term financial protection, provide substantial supplemental retirement income by accessing the cash value, protect the business's financial interest. These are sophisticated strategies and must be structured carefully with legal professionals. Income taxation and diversification. Now let's talk about something every business owner worries about: taxes in retirement. Common retirement savings today are 401ks, IRAs, qualified plans, all taxable upon distribution. That can create tax concentration risk. Cash value life insurance can provide tax-deferred accumulation, potential tax-free access via loans if structured properly, no required minimum distributions, no contribution limits tied to income. This can create tax efficiency. Think of retirement income like a 3-bucket strategy: taxable, tax-deferred, tax-free. Life insurance can serve as the tax-free bucket, providing flexibility when managing retirement income, Social Security taxation, Medicare premiums, and legacy planning. For business owners who often sell their company and face large liquidity events, tax diversification becomes even more important. Business planning isn't just about growth. It's about protection, continuity, retention, exit, and long-term efficiency. Life insurance, when structured correctly, in addition to a death benefit, it can be used to fund a buy-sell agreement, a key person protection strategy, an executive bonus solution, a deferred compensation funding asset, a split dollar mechanism, and a tax diversification vehicle. The key is proper design and alignment with legal, tax, and financial professionals. If you are a business owner or financial professional and haven't reviewed these financial strategies recently, it may be time. Because the cost of not being prepared is always greater than the cost of structuring it correctly. Thanks for watching.